Vanguard. It's safe, it's sensible, but it does hurt me to say it's a little bit boring. So when Vanguard makes the effort to publish an article on the Wild West in terms of Bitcoin and the wider cryptocurrency universe, then I think it's more than warranted to look at. There couldn't be two bigger polar opposites. Vanguard is all about historical data and predictable outcomes, where cryptocurrencies paint a picture of the ultimate downfall of the modern economy and highlights the need for blockchain technology to enhance our lives in the future. But this article has put me in a very awkward position. On one side, I'm heavily invested into Vanguard, but on the other, I've recently and very passionately opened a position on Crypto.com. We all hate it when mum and dad fight, which is how I felt when Vanguard released an article highlighting why you shouldn't invest in cryptocurrencies and how it is no replacement for other traditional investments such as stocks and bonds. So today, I'm going to go through Vanguard's recent article authored by no other than Rodger Aliaga-Diaz, who is Vanguard's head of portfolio construction. I'm going to highlight the key points which I find interesting and give you my thoughts on what he has to say. I have to say, Rodger gave me quite a few head in hands moments, but I'll get to them shortly. So, the article is titled "Digital Currencies Are No Substitute for Shares and Bonds." Not a very surprising article title from Vanguard, let's be honest. They aren't in a position to make money out of people who want to invest in crypto, and if anything, investors going into crypto could be using their money to invest in Vanguard, so if anything, it's a little bit of a competitor at the moment. I imagine this article was a result of many of Vanguard's investors asking them about, are they going to have a crypto ETF, what are they going to do in the future, all those sorts of questions. In the opening few paragraphs, Rodger highlights that cryptocurrencies are largely unregulated. Well, thanks Rodger, didn't see that one coming from a technology which is all about decentralising systems. But in fairness, I do think he's trying to educate his audience. I can't imagine the average age of Vanguard's users is anywhere below 50. He then goes on to explain what cryptocurrencies are by giving examples of Bitcoin, Dogecoin, Ethereum, Ripple, Tether and Litecoin. He interestingly highlighted Tether, which I thought was a really odd choice as it's a stable coin. In this case with Tether, it's pegged to the US dollar. So questioning the validity of it already is a little bit odd, as it's the same as holding cash. It's got nothing to do with investing. He then goes on to say that virtual currencies operate without a centralised authority, so the very basics of blockchain technology. The next part of the article does tickle me when Rodger clarifies the following.
The fact that cryptocurrencies are not issued by a central bank is actually the very reason why they can't achieve the quality of other well-accepted currencies. The role of a central bank is precisely to preserve the value of the currency by keeping inflation under control.
Well, central banks and fiat currencies must be bulletproof then, Rodger. He then goes on to explain why he believes that they aren't any replacement for stocks and bonds by saying,
but unlike traditional asset classes, cryptocurrencies lack intrinsic value and generate no cash flows, such as interest payments or dividends, which could explain their price.
I personally agree that they aren't any full replacement for stocks and shares, but Rodger is wrong by saying they don't offer any cash flows. It is a fact, he is wrong. Some cryptocurrencies do something similar to interest payments or dividends. This is done through proof of stake. Proof of stake is a type of consensus mechanism by which blockchain networks achieve distributed consensus, which is a fancy way of saying it keeps the system going. By staking the coins you hold, this facilitates this process of the network working basically. You get your coins back, but you're also given a reward alongside it of supporting the network. It's a bit like when you lend governments money in the form of a bond. You get your money back plus a little bit extra. The valuation of cryptocurrencies is far tougher as they're not like any other investment class that we've seen before. Bitcoin is aiming to be the virtual version of gold, which some people might scoff at, but gold is only worth what we all agree it's worth, just like how cryptocurrencies work. Based on gold's valuation, Bitcoin should 10x from where it currently is to catch up to where gold is now. The other cryptocurrencies are more challenging, and I believe they're probably best compared to companies like Tesla. Give me a second to explain. There is a general belief that the given company, so Tesla, or certain cryptocurrencies, are working on solving a problem or improving the status quo, but it isn't quite there yet. The price is currently based on the probability of it coming off and the impact they might have on humanity. The problem with cryptocurrencies is you're depending more on the shared belief behind each cryptocurrency than actual any sales, which in fairness Tesla do have quite a lot of. This means it can move up and down far more quickly than other investment types. This sort of thinking can create massive bubbles. I'll talk more about tech bubbles shortly, but I actually want to quickly reference a bubble which critics of crypto point to, and in fairness, I think it's quite a valid critique. Let me explain, and you might be able to see a few parallels. The Dutch tulip bulb market bubble, also known as tulip mania if you hadn't heard, was one of the most extreme bubbles ever seen. In the mid-1600s, tulips were seen as a wealth symbol in the Netherlands, so they already carried a high value due to a limited supply, as at the time you could only import them from Turkey. The bubble started when there was a significant premium for broken bulbs, which were a type of tulip which were multicoloured, as opposed to the standard ones which were solid colours. They were very rare and very desirable. Once the price started moving up, more and more people saw other people were making money just by owning bulbs. This was a self-fulfilling prophecy as more and more people entered the market, and it actually eventually ended up with people taking out massive loans just to buy a bulb. At its peak, the best bulbs were selling for as much as £540,000 in today's money. As the supply wasn't limited, coupled with the fact that some individuals needed to start to repay these loans, people started to need to sell their assets or the bulbs. The bubble then burst just as quickly as it ramped up. The bulbs weren't producing anything, so there was no real good basis of valuation other than supply and demand. But what has this got to do with crypto? Well, to keep the response brief, let's look at Bitcoin. It purely gets its value from a consensus from other individuals that it has value. It doesn't produce anything, just like gold. You might argue that we fell in love with the shiny metallic yellow bricks, which helped give it value, and it is more believable about falling in love with a shiny metal than actually falling in love with some code that you never see. Gold does have some uses in the real world, which gives it some value, but they are very limited uses. You could mine more gold, so its supply isn't limited, just like the tulip bulbs, I guess. But with Bitcoin, there is a finite amount that you can have. You can't just produce more Bitcoin out of nowhere. But like the bulb scene, its value was underpinned by somebody's belief, which means the price could skyrocket or plummet at the same time. Anyone arguing against Bitcoin, in my mind, is arguing against gold. So, back to the article. Rodger went on to say,
some investors may be willing to bet on sustained crypto price increases based on the belief that crypto demand will always outpace its supply. The supply of crypto has exploded over time, but there is no reason to believe that supply can't keep up with demand.
I've got to say, Rodger has completely lost me here with what he's arguing about supply. Is he arguing that there could be an increased supply of different types of crypto projects, or that existing cryptos could just make more of them? Well, whichever he means is either incorrect or it's not valid. If it's the former, an increased supply of different cryptocurrencies is the exact same as another company forming. For example, someone forming a social media company. Why is this a bad thing? It's natural competition to see who can make the best products in the market. If it's the latter, then he's incorrect. Most cryptocurrencies only have a finite supply. There will only ever be 21 million Bitcoin. Fact. As the latter is wrong, let's make the assumption that Rodger is meaning the former. So then, come on. Does anybody remember the tech bubble? We kind of saw exactly the same thing we saw here. Multiple companies were jumping on the back of a new technology called the internet. You might have heard of it. A lot of the companies went bust at this time due to the overhype around the new technology versus the actual substance that they could deliver at the time. But can we think of any winners that came out of this space? You might think of Amazon or eBay. If you held Amazon stock at this time, you would have 100x your investment in over 20 years. Not bad. Just because there's a lot of startups within a new technology doesn't mean it's a bad place to invest money. Surely it has legitimacy more than anything. Looking at the dot-com bubble, it just shows that you need to be wary of the risks and actually the need to probably be quite well diversified. I do have to agree though that there is a lot of speculation within this space, but it's nothing that we haven't seen recently already with Tesla that has a PE ratio above 1300. That's including Vanguard's portfolios, so what's the difference? They're both relying on execution in the future as part of the valuation today. Rodger wraps up the article by highlighting liquidity, pricing and regulatory risks. The only part worth highlighting here is that he warns that governments might restrict cryptocurrencies, which I think is partly laughable because they're decentralised, so I'm not sure how you're going to go about this. You see it with the war on drugs, you can try and restrict it, but if the product is valuable enough, then someone's going to find a way to use it. After that, there isn't anything massively noteworthy to mention. So the tone of the article isn't surprising. Vanguard has it all to lose and nothing to gain from supporting cryptocurrency at this time, so why would they bother saying anything different? My main disappointment is a general misunderstanding from Rodger on cryptocurrencies. I would have preferred something a lot more balanced, and with a wrap up clarifying that they don't believe it's good for investors in the long term. I could deal with that. But pointing at Tether and saying it's not a good investment is the same as pointing at a $1 bill and suggesting it isn't worth paying $1 for. It just highlights a complete lack of research on their behalf. On top of this, throughout the article, it's clear that he doesn't understand the basic principles of blockchain technology and its goal to remove centralised gatekeepers. Personally, I'm not ultra bullish on the outcome of cryptocurrencies. However, I acknowledge that there's a chance that they could significantly disrupt life as we know it in a positive way, meaning that Rodger and the Vanguard group could be looking extremely foolish if cryptocurrency turns into a new asset class, as they'll be forced to do something about it. It'd be a bit like their platform not offering bonds today. The way crypto is moving to a proof-of-stake system means that there is a viable way for investors to make money. So as long as the system sticks to this system and that crypto adoption becomes increased in the future due to the value that it's adding to society, it's going to definitely happen. Due to this, I feel it's logical to have a small position in crypto as a percentage of your total portfolio. For me, it's around about 2%, which is diversified across several cryptocurrencies. Anyone who is fully invested in crypto before they have any money invested in the classic stock market, in my opinion, are really foolish. I'm happy for them to be right in the long term, I just don't think it's worth the risk. But if you haven't invested into crypto directly, does that mean you don't have any exposure to it? Well, here's some food for thought. There's a good chance you actually hold a small amount of exposure if you hold a globally diversified ETF. We've seen many big companies starting to hold positions within Bitcoin. Those include Tesla, MicroStrategy, PayPal and Square. So if you own any of these companies, then part of their valuation is tied to the current price of Bitcoin. And this isn't to say that further adoption might take place within the coming years by either other companies or financial institutions. So, do you think Rodger is right on this one? Do you think the Vanguard might have to reverse their stance on cryptocurrencies in the future? Let me know in the comments below. I'd genuinely be interested to hear your thoughts. So, I hope you've enjoyed this video and that you've learned something. If you still have any questions or comments, then I'll try my best to reply to you in the comments below. I do other videos on this channel around investing, finance and income growth. These include updates on my own investment portfolios, which are primarily around Vanguard, but I do have other investment portfolios, such as my crypto portfolio on crypto.com, so feel free to check them out. That's all for this video. See you in the next one.